No problem. All right, without further ado, let's start with a debate. First affirmative, anytime when you're ready.
Cool.
Sorry, give me 2 seconds.
Cool, then we got it.
The way high frequency trading works is it tries to get as much money out of the stock market as possible. What does this mean? Well, firstly, it means it gets rid of incentives on companies to actually attract investors to grow and to do good things as companies. And secondly, it hurts really small time investors who stand to benefit a lot from the stock market. So what do we care about in this debate? Well, we think we care about two things. One, we care about protecting these small time investors who the stock market provides a massive advantage to, and who we think should be able to use it as much as possible due to the extent to which it can help improve their lives. And secondly, we think we care about creating an economy that drives innovation and that makes jobs for people, because ultimately that provides a huge number of material benefits to the country as a whole in terms of having a healthy economy, but also to the people in terms of being employed, and also to society in terms of driving good development. What am I going to do in my speech today? Firstly, I'm going to talk about small time investors and how it's really important that we allow them to invest, and why high frequency trading locks them out. And then we'll talk about the impact on companies. So what do people who use the stock market kind of look like? We think that for a lot of people who use the stock market are your university student who's interested in economics and wants to try get rid of their student debt by making some money on the stock market. Or we think it looks like your kind of mum and pop investors who have saved up a bit of money for their retirement and need a way to improve their retirement fund and want to try and make some money off the stock market. We think these people stand to gain a huge amount when the stock market benefits them. We think overall their quality of life can be greatly improved by making money off the stock market. We think at the point at which the stock market, high frequency trading, is only going to benefit huge investment companies who already get massive benefits under the status quo. We don't think these people are the important people to care about in this debate. We think we much want to prefer that we would rather protect the people who stand to gain a lot. So why does high frequency trading lock people out? Well, firstly, for these small time investors that only have a couple of $1,000s to invest, they can't join big investment companies because the price of entering these companies is so high, because these companies have huge costs in terms of getting the best computers when they need to have them for high frequency trading, and getting the best technology. So we think these people are locked out. But we also think that the type of investor we're talking about tends to be the person who does it on their phone in between lectures, or does it because they're retired and have nothing else to do, and so is always going to be limited and always going to want to do this in person. So why does high frequency trading lock them out? Well, under high frequency trading, when a company looks like it is going to start growing, huge numbers of shares are bought up incredibly quickly by these computers. This means that prices go up, but that means that they also really quickly hit the maximum sustainable price, and then they start being sold again really quickly by these companies in order to so these companies don't make a loss and don't hold on to shares so the high frequency trading computers aren't selling the shares at a loss. How does this lock out the mum and pop investors? Well, it means by the time the mum and pop investors realize that, oh, these stocks are going up in value, we should buy some, they've already started to be sold again and are already going down in value. These people just don't have the time to keep up with the incredibly fast pace that this occurs occurs when it's done by like computers that can literally do it in seconds, and we think that it just like moves things up too quickly for these people to follow. What does this mean? It means these people can't use this as a way to like save for their retirement. It means university students can't use this as a way to pay off their student debt, and we think that those people stand to benefit a lot, and that's why we care about them. Now let's talk about companies. Under the status quo, companies really benefit when they make themselves seem like a good company to invest in. They do this through like a variety of ways that aren't just limited to like having good economics. What do these kind of reasons look like, and why are they important? So it looks like, firstly, it looks like having a potential for growth, like, you know, there being good economics in the market. And while we accept those are things that high frequency trading can probably also like assess, we think when this is done by humans look at a variety of other factors. They look at things like, is the company ethical? Is it sustainable? We know human investors look at things like this because we know people, when they like get a human trader to like invest on their behalf, you know, care about these things. Like that's the reason Kiwi Bank like only has like a sustainable investment policy. So people care about these things. We think people who like, when they decide they're going to invest their money in something, they like want to invest in a cool company. They want to like stand by that company and watch it grow. So they tend to invest in things like technology that are going to have like wide growth and wide innovation, because people like to be associated with a successful company like that. And we think these are things that are never going to be looked at by high frequency trading computers. So let's look at, so on the like, so when we have high frequency trading computers, like these computers are only trying to make money off of the companies, right? So, and the one way they can do this is by intentionally tanking companies, by like pulling out as quickly as possible. Why would they do this? Well, it minimizes their risk of like, you know, they pull out really early on so they can sell the shares still at a profit, and then so they minimize their risk. And we think they also like just pull out reasonably quickly because they're like, oh, now we can invest this money in somewhere else, in the next like booming thing which is happening. And this, as I explained before, happens way more quickly. So companies are so the computers are like incentivized to like quickly move money around as much as possible. Whereas under the status quo, companies as trying to attract shareholders and trying to attract investors and trying to attract like stock market traders, make themselves look good in other ways. They make themselves look good in terms of being ethical, in terms of being sustainable, in terms of like driving good innovation and creating products that people want. We think that when it is not done by high frequency like computers, that these incentives on these companies completely like fall away. Suddenly they don't care about being ethical. They don't care about like creating innovative products, because that doesn't attract them any investment which they need to survive. We think it's really important that we have companies that do want to create jobs, that do want to like be ethical, that do want to like innovate and come up with products that genuinely improve the life of like human beings. And we don't get that under high frequency trading, because like eventually the stock market is just seen as a way to make money, and like the natural conclusion of things is that eventually these computers get so good at trading with one another that it just reaches a stalemate and the stock market loses all value. So at the end of that, we stand for protecting like good companies, and that happens when we have human-based trading.
Thank you, first affirmative. Next, I'd like to call upon the first negative. Here.
Hi, am I audible?
Yes, you are.
All right, cool. I'm gonna start in 3, 2, 1. Okay, first I'm going to clarify two things about high frequency trading, and these are just factual things which we think that Affirmative have got it all wrong. Firstly, on not having any motivation or creating an incentive for companies to not innovate. Firstly, the mechanism for this is shoddy at best, which is to say stock markets seem to be the only way to make a certain amount of money, and therefore people will only play the stock market, and for some reason companies are going to be perfectly happy with their stocks being bought and sold. We think that the prices of stocks are not an arbitrary amount of money that companies choose to pick. The price of a stock is oftentimes based on the valuation of the company, which is dependent on things like, for example, how much money or profit that company makes at the end of the year, how much financial profit do they report, and so on and so forth. We think that there's an increasing incentive for companies to actually be transparent, because recognize that high frequency trading takes in a large amounts of data from many different news sources, and we think that by openly being innovative and openly trying to sell yourself as a company that is actually making real changes and incentivizes them to do better and create more profit, that's what's going to increase your stock price, and that's what's going to attract people to buy. And we think that these companies are no longer going to have to rely on things like companies with high-tech analysts and only those companies being able to invest in these companies. Now, with access to this technology, everybody can choose to invest in these companies, which I'll talk about later on in my speech. Secondly, on how this actually makes the market more stable, I think there's a fundamental contradiction in their case when firstly they tell us that high-frequency trading is going to result in huge volatility of the market, but in their second speech, to try and prove that markets are going to become stagnant, they tell us the opposite. I want their second speaker to tell us who's right and why. But here's the truth. The truth is that it doesn't lock people out of the market, because high frequency trading, high frequency here doesn't refer to high radio frequencies. High frequency means that there's many instances of trades, which is to say that notice that for every stock that you want to buy on the stock market, you have to buy it from somebody else. Whenever you put out a request to buy, somebody has to put out a request to sell, which means that that's an exchange of stock. What this means is that high frequency trading actually means that there are many small incremental buys and sells, so that the individual person who owns the high frequency trading technology is able to make small profits over a long term instead of the comparatives that I'm going to tell you later on. But there's large amounts of trades, and these huge amounts and numbers of AIs which are making these trades means that the market actually balances out, because every time a stock is bought, another bot realizes that that stock is being bought and adjusts their price accordingly. We don't think that this is going to cause a market crash. Rather, ever since high frequency trading has been introduced into markets, first on Wall Street in 2004 and later to the public hands in options such as IQX option or Stash Away in 2008, the markets have actually become more stable and less volatile, precisely because humans aren't messing it up with their stupid trading decisions. So here's the outright rebuttals. Firstly, on the comparative, what do we think that people are likely to look like if they don't have access to high frequency trading? We think these are going to look like your day traders. So if you ever played the Nintendo 3DS, they have this cute little mini game where you essentially do day trading, which is to say, at the start of the day, you buy a large amount of a certain stock. And throughout the course of the day, you're trying to find a place in which you can sell all of that stock at once for profit. We think there are two problems with this. Firstly, it's fundamentally inaccessible to the people on the ground, which is to say only your dedicated traders who are spending all of their money to buy all of these large amounts of stocks can participate in it. Secondly, we think what ends up happening is that you have huge amounts of stock being bought and huge amounts of stock being sold all at once, instead of in the frame of high frequency trading, lots of small trades here and there, which means that the market is fundamentally unable to adjust to this huge injection or subtraction of stocks, creating even greater market volatility. Secondly, we think that banning this technology, which is the metric that side Affirmative needs to defend, has not been met. Insofar as we think allowing this technology to be out there, allowing this technology to flow and be able to be developed upon and innovated upon, allows multiple people to get access to this technology and therefore benefit from it. I'm going to tell you three things for the house today. Firstly, I'm going to tell you why it's necessary. First, recognize that the kinds of individuals that we need to appeal for in this debate is not, as Affirmative says, it's not individuals who are part-time economics students or day trade or dedicated traders like your mom and pop. We think stock markets should be accessible to all individuals. And we think if their metric is on allowing people to participate in the stock market, we do that better. Precisely because of options like IQ option or IQX option, Stashaway, Pro Traders apps, these technologies have become developed to such a point that every individual can basically download an app on their phone, create a stock market account, and participate in these stock markets without having to think about it. We think that this drastically reduces the barrier for entry, precisely because the bots and AIs that are making use of this technology don't require any human input, and therefore people can make use of it even if they don't have any knowledge of the stock market and can therefore participate in that. But secondly, right, we think it's particularly important because real median wages have not increased since the 2008 financial depression, precisely because of bad politicians, bad government policy, income inequality, all these things that we wish we could solve. But unfortunately, this debate isn't necessarily about that. So the question then is, how do we secure secondary sources of income for individuals on the ground? And we think we can only do that by creating accessible options for everybody to participate in. Secondly, why do we think it's particularly fair for these technologies to be allowed? We think that at the point in which you create a more accessible outcome is one where it is more fair. Recognize that the entire process of making an international, IPO or public offering is precisely because you want the people on the ground to invest in your company. You want the directions, the incentives, and the motivations to come from people on the ground. We think that in a comparative where high frequency trading is banned, and companies, stock firms, and dedicated traders are able to revert to other kinds of technologies that aren't high frequency trading, things like the kinds of market analysis that happened in the late 90s, I think, and things like being able to be at Wall Street for 24/7. We think that these are fundamentally inaccessible to the people on the ground and result in these companies' investors only being your richest of the rich, your elites, the ones who can spend time in offices all day, making sure that trades are going their way. We think that's fundamentally unfair to the people on the ground. We think that goes against the very idea of what a public stock exchange should be. But lastly, on why it's particularly effective. So firstly, we think the advantage of opening this technology up to all individuals is that oftentimes what happens when this technology becomes commercial is that many different commercial individuals are allowed to collectively amass their wealth and put it into investments. Notice that a fundamental concession that Affirmative makes is that oftentimes you need $1,000 to $2,000 to begin investing. The reason for this is because stock markets have minimum buys of how many stocks you need to acquire. What this means is that if you have, for example, a commercial platform of high frequency traders where people are likely to buy into this because they trust in the AI, precisely because they feel like they can participate. This means that they can put all of their money together to be able to buy a single stock and then split the dividends and split the profits from when that stock actually benefits and from when that stock actually gains money. Secondly, we think minimal research is a key effort into buying in, because the whole problem with the stock market right now, and the reason why most of us probably don't have stocks unless we're like of the rich and our parents tell us what stocks to invest in, is precisely because these informations are often opaque and inaccessible to the people on the ground. We think high frequency trading alleviates most of our concerns and allows us to participate in this system which Affirmative wants us to participate in so bad. Thirdly, we think it levels the playing field, which is to say high frequency trading is highly portable. The kinds of technology that stock markets, stock firms, and companies are using is going to be the same kinds of technology that human beings on the ground, your mom and pop, your like regular high school student, are going to be the ones who are using these things. We think that at the point in which we have access to this technology and not, for example, a shady business who is doing this behind back doors, who is doing this underground, it means that we're able to level the playing field and therefore allow more people to benefit from this stock market. For those reasons, go aside, negative.
Thank you, first negative. Next, I'd like to invite the second affirmative. Here.
Hi, can everyone hear me?
Yes.
Awesome. In a world where your average parental couple aren't able to rely on their house as an asset for their retirement, you see people moving towards stocks, putting a couple grand in there and watching it grow over the progression of their lives. However, you harm them at the point where trades take place instantaneously because a grandmother who is doing that trade on her phone can never keep up. We don't think that's equitable. We don't think that's fair. Couple of things in the speech. Firstly, on like the individual harms of high frequency trading. Secondly, on like the economic side and how companies incentive shifts. And then finally, a split point on how this harms the stock market as a tool for economic health. Firstly, on this idea of the individual. Basically, we think individuals in this debate are particularly important because we think financial institutions should always be set up to help individuals. Specifically, we extend on a principled level that financial institutions should be set up in a way that helps the people who most need that financial help. This looks like
Sorry, I think we
excuse me.
lost you.
Yeah.
university students. This was like parents that will do interest in like massive amounts of, is my connection stable as well? Yeah, and like high amounts of like financial institutions probably just are fine on either side of the house. They probably make their money, get their $100,000 salary, and that's fine at the end of the day. So we think at the end of this like point, we should probably prioritize individuals more, particularly the individuals we're talking about because they're like harmed the most. So what have the negating team said? They told us that everyone should have access, and the point where you have high frequency trading that lowers the barrier of entry so everyone can get in. We think this like perfectly just mischaracterizes the type of investment that your average mum and dad does. The point where you're relying on high frequency trading in order to buy like individual stocks like on Sharesies or something, you're probably just investing in a hedge funds at that point. We don't see that as the reality of like what people actually do. They probably just look at the like the NZX 50 or the Dow Jones and see a couple of stocks doing well and just put a couple $1,000s in that stock. They probably don't go to a hedge fund and then rely on high frequency trading of other financial institutes to get that. So therefore, we don't see the barrier of entry due to these like high frequency trading existing being particularly relevant. So what did we tell you on the outside of the house? We told you that the key importance of high frequency trading was that it squeezes profit out of like investors in order to make it profitable. We told you this is particularly harmful for individuals who aren't able to keep up. First of all, we told you that by the time they see the price of a share increase, by the time they want to sell it off, they won't have enough time to do that and they'll lose out and they'll lose money off that stock. We think that's particularly harmful. But secondly, we told you that futures become so good at trading the stocks that even if you're an average person share trader, you probably just can't compete with that. So you see very, very little people like trading in stocks. But secondly, if you are like a human trading business, you probably want to invest in this material to the point where you get perfect computers, which basically makes this debate a stalemate of computers just being perfect at trading and nothing really happening. But crucially, that locks the kinds of people we wanted to talk to you out of that deal because they're never able to do it quick enough on their phones because they do it in between lectures. Amelia brought you that material. At the end of this point, we've shown you why these particular individuals that we're talking about in this debate are the most important and how the greatest harms at the point where you have high frequency trading. Now we're going to move on to the material about the economy. Quickly, the negating team wanted to tell us that in the long run, like the economic harms of this balance each other out because people buy and sell large amounts of stocks in equal proportions. Firstly, we tell you that people, probably individuals, don't buy incredible amounts of stock to the point where it causes economic disruption because people tend to be way more rational about how they spend their money. They're probably unwilling to put like $25 million on this one deal at the point where they're having to accurately review that using not like some sort of computer algorithm, but their own logic. People probably don't trust themselves enough to put that money in. So you probably don't get massive shifts in the economy under our side of the house. You do at the point where that algorithm jumps on an opportunity to squeeze money out of an investor, which means you end up with way more economic disruption. But secondly, we told you that you change the incentives on particular companies at the point where they're going to prioritize things that are attractive for that computer program, not things that are attractive to the people who would normally buy stocks. We tell you that CEOs basically get paid based on how much their share prices do, and like boards of companies actively prioritize share price as one of the key metrics for their company's success, which means you completely change company incentives at the point in time where the way that trading happens changes. Because currently we tell you that people buy shares with other incentives in place, such as, is that company ethical? Is that company fair? But this trading application and this computer will only look at very granular economic analysis, which means companies shift to not be as ethical and to only focus on their economic detail. We tell you this is harmful on like a humanistic level, but also probably harmful to the economy at the point where this becomes unsustainable. The end of this, we've shown you why we get better outcomes for individuals and the economy at the point where you don't have high frequency trading. Now I'm going to move on to my split point about how this harms the stock market as a tool economic health. The context which this point sits under is historically and today, we see the market is used as a metric for economic success. The point where Donald Trump is like advocating for the success of the Dow Jones as a sign that he's doing well in the American economy. It probably just proves this point alone. But we also see that like signs of the stock market tanking probably correlate reasonably well with economic depressions. Why is this? Because we think that's like to some extent an accurate reflection on how people view and how people judge particular commodities in society and how people judge the value of particular businesses. We think this is a decision based off wide range of things, such as is that business like particularly good actors in the world, and like economic decisions as well. So how does this change at the point where you have high frequency trading? First of all, we tell you that high frequency trading becomes more sporadic at the point where you can buy big and sell big incredibly rapidly to the point where no one can keep up. We see that this changes is so rapid at the point that you probably don't understand the impact that is happening. If you turn on a stock market cable news television, and you see like the Dow Jones rapidly fluctuating over the course of a day due to massive differences in how like commodities are being bought and sold, we see that people probably just see that as concerning and see that as quite arbitrary, which means you aren't able to accurately measure the health of the economy over that day. But second of all, we say that people probably just let the machines learn by themselves, because the way that machine learning works is that you probably implement the algorithm and then the algorithm just gets better at doing its job over time, which means people get to a point where they don't understand the legitimate reasons why those trades exist, to the point where it's fully automated and being made without that decision, which means probably used, the point where you don't understand the reasons for why those stocks are being sold. That stock market becomes particularly bad at telling us anything about why the economy is doing what it is. That means it's particularly bad at informing particularly economic decisions when it comes to policy making, but also in just in terms of companies wanting to invest, and all of their decisions that they use the stock market for now probably changes under our side of the house. But lastly, we tell you that at the point the stock market becomes something which doesn't favor families or university students, the people we want to talk about, but rather favors large financial institutions that are always going to be better off, like always going to be good under either side of the house, we tell you that's not a key metric for economic success. The stock market was better when it had people trading individually. It was a good sign of economic health. It was good for people. It was good for the economy. We're very proud to affirm.
Thank you, second affirmative. Next, I'd like to call upon the second negative. You're here.
Hi, am I audible?
Yes, you are.
Okay. 3, 2, 1. I think a lot of the analysis coming out from Affirmative hinges on one key assumption, right? That high frequency trading actually creates a lot of volatility, and that because of that, it leads to their whole points about either the economy somehow being stagnant, or at the same time the stock market no longer being a good indicator of economic health, right? I've got a few responses before I go into my main substantive material. So I think the first issue on like this individual, like the kind of individuals we're prioritizing here, right? Recognize that there is no disagreement between who we want to prioritize, both on affirmative or negative, right? I think on both sides, we agree that we're looking at individual investors who don't necessarily have the massive capital, who are not necessarily your Warren Buffett or, some other guy like that, right? We think that that's where their key contradiction lies. I think there's a fundamental contradiction when they say that these individuals prioritize things like long-term trades, and hence because, they don't have the time to look at the stock market every other hour, every other minute. And then at the same time, they tell us that you cannot keep up with these high-frequency traders, right? Recognize that these high-frequency traders, like high-frequency trades, happen on such a minuscule level that it is meant for like humans to not be able to catch up with them. But for the same reason, these minuscule traits happen on such a balanced level, which I'll prove later on, that there is no real impact in the long term caused by these high frequency traits. We think that what causes changes in, for example, stock prices over a period of 10 years, which is what we're looking at if you're, for example, preparing for your retirement, right, are things like the economic health of your country, the success of the individual companies, and the innovativeness of these countries, of like the global economy as a whole, right? We think that these things don't change because of high frequency trading. We don't necessarily see why like your economic health is going to decrease because of high frequency trades, because I think they like to characterize the stock market as being this kind of like big like cause of economic changes, when it is in fact often reflective of what we see in the economy, right? Which means that more likely than not, your huge increases in stock prices, for example, for electronics company, come when government policies change, come when, for example, things in the global economy changes. We think that, for example, if the world shifts to like, for example, AI computing, there's going to be a shift in the stock prices for AI computers, but for a much higher degree. What's the difference with high frequency trading? Justin already comes up to tell you that there is a balance in the sense that you have multiple bots doing this and balancing this fight against each other. Yes, they tell us that, you know, your bot, your high frequency trading bot will come out and just, you know, like aim to like jump at opportunities to sell, which causes volatility. Why is this not true? I think first of all, we need to recognize that because this is made out of multiple bots, and we agree that there's a huge amount of them in the market, what's going to happen is that when one bot decides to sell, the prices falls, and then when the prices reaches another threshold, other bots come in to buy, right? We think that due to the sheer number of bots and the fact that they react instantaneously means that you're actually far less likely to find volatility, because all these bots react at virtually the same moment, which means that you see this rapid balance, which means that like what you're going to end up seeing is perhaps like a huge fluctuation, like constant fluctuation of a few cents for the stock prices. We don't think this is very like important for your individual stock, for your individual traders anyway, right? Next, on their point on the economic health of a nation, I think like they come out and give this idea that, you know, that that we look at the Dow Jones to actually like measure the health of the economy. I think the first response to this is the fact that this is not true. This is something that individuals like Trump and whatnot like to push forward, but recognize that again, Trump has business ties and his incentive for the stock market is for his own benefit, not the benefit of the economy. I think on a second level, we need to understand on like why the trade market isn't like why the stock market isn't an indicator of economic health is the fact that it is a reactive market, right? It is the fact that when certain government policies happen, the stock markets, traders, and bots alike change accordingly. We think what's the difference on our side is the fact that you bots actually can do this on a, while not necessarily understandable level, which we concede on, they do it in a predictable manner, right? We think that that's possible because insofar as these bots have a consistent reaction. The difference with humans is the fact that they can look at one government policy one day and decide that they should buy into stocks, and when a similar policy happens 5 years down the road, somehow they choose to sell stocks instead. We think that that's a kind of difference that's caused by human irrationality that makes the stock market an even worse indicator of any economic health if they wanted to have that, right? And I think finally on that point, right, is the fact that they come up to tell us that people won't understand why certain trades happen. I think this firstly hinges on the fact that like on their initial characterization that, you know, stocks will become volatile and like they will vary wildly. I've already proven to you this isn't true, right? I think when they come to tell us that why this will affect policy making is even worse because of the fact that, again, the stock market is no indicator of economic health. They're indicators like GDP, GNP, and other things like that, which governments use. We do not use the stock market purely because it is a market in which people trade for certain stocks. Governments do not react to specific stocks of companies. They react to the general health of the economy, both internal and global. Right. Okay. So now I'm gonna go into more analysis on exactly like why we create a more rational stock market and how like even if like somehow we have retail traders on our end, they actually end up benefiting. Because recognize that first of all, I think that when we have like stable like when we're looking at trade markets, right, when we're looking at stock markets, you generally have investors who want to make certain trades. I think what's a key problem with humans in general is the fact that they suffer from two huge problems. Number one, that they're often forgetful of certain things, like for example, information from a few months past, even if they're still relevant to economic conditions today. And second is the fact that we always have imperfect information insofar as like we compare this with kind of database of information possibly available to us. It's just based on our own ability to process information and our own ability to search for information. I think what's the problem in today's world is the fact that you have these like high frequency traders, or rather what's the problem in their world is the fact that these individuals have very inconsistent approaches to actually investing. We think that this happens in a case of like individuals not knowing enough or not not actually having the proper like mindsets between it. It's precisely because we have like things like university students and like not kids lah, but like less informed individuals making these stocks that make stocks so volatile, right? That compared to someone who has an economically sound mind, the volatility of stocks doesn't make sense because you have these irrational traders actually making stocks, making trades, right? We think the difference on our end when you have people buying into like high frequencies, when you have people putting their money into stash away and whatnot, right? It's the fact that they're still able to see gains while at the same time not affecting the kind of stability of the market. We think that's particularly useful in a world for two reasons. We think first of all, when you have a stabler market in general, I think that other investors, especially foreign investors, are more likely to put money into a country, right? Because we think that when stocks are stable, you're more likely to believe that the companies within these countries are actually well performing and they're not doing such things, right? We think that obviously, like, if you're gonna see a fluctuation of a few cents like consistently, right, we think that's just normal with any kind of like stock market and any stock on the market, that things adjust by a few cents every now and then. We think that's fine. We think that what matters to these foreign investors is that these things don't fluctuate wildly because a bunch of like dumb investors just like decided to like short sell something because they saw one big bad news which turned out to not actually be that important, right? We think what happens in this case is that we create more rational decision making for foreign investors, and that these high frequency traders are able to then actually be able to adjust for this mechanism. We think high frequency traders give like companies and whatnot, or give both like these companies who employ it as well as these individual traders who put money into stash away an opportunity to actually gain money while at the same time not having their own irrationality actually put forward in this. Justin already gives you the reasons why these individuals already don't need to spend that much research on it thanks to these technologies. I've further shown to you why necessarily having them out of the market, out of actually being able to influence market prices, is actually better, because high frequency traders are ultimately a better form of trading on the market, and we benefit both individuals in the long run as well as other investors because of that stand with negative.
How's that, Edge? Hello? Can you hear me and whatnot?
Yes, you're audible.
Okay, cool.
Wait, Tiffany, are you there?
I think Tiffany disconnected.
When did she disconnect? Considering she's the chair.
The chair is maybe.
Oh my god. Give me 2 seconds.
Okay, that's fine.
Hi, sorry. I think I dropped out during the last 5 seconds of second negative speech. Have we started with the third affirmative?
No, we haven't, because we realized. Anyhow, like, it's up to you how you want to proceed, whether or not you want to give extra time towards the last speaker.
All right. Okay. If we can continue, third affirmative can start anytime.
High frequency trading is the application of machine learning to the stock market to maximize profit. So eventually, and slowly but surely, via evolutionary algorithms, it approaches what is the maximal, like, perfect trader that it can be, right? This is how this technology works. And that's built upon squeezing as much money out of other investors, whether because the algorithm isn't as sophisticated, or they're doing it by hand, or their connection isn't as quick, right? That is the basis of high frequency trading. And that's why inherently you get the harms that exist under the opposing side of the house, right? You squeeze out lower down investors who are less sophisticated. And also important to recognize that as they approach more similar versions of the algorithms, they start to act more similarly to each other. And so the weights of the decisions that those algorithms make are amplified over time. That's the harm we want to avoid. That's why we win this debate. Okay, two main halves of this debate. Firstly, individual harm to lower down traders, and secondly, the economic harms of high frequency trading. So we point, like, high frequency trading just wouldn't exist if it wasn't asymmetrical, right? The claim that it balances out because their computers are just selling to each other is to ignore why this technology would even exist in the first place, right? Presumably, if that's true, then these algorithms just can't make money, right? Because if you're making a trade, you are the person who should be benefiting from that trade. And that's why the algorithm is doing that, right? So it's just like, to assert that they would just be equal and that they wouldn't make money is like an assertion that is just incongruent with the reality that would have to exist for this technology to be viable in the first place. So that's just not true. And that's like the basis of a lot of their responses to our individual harm. Okay, so they wanted to claim that it's like a secondary source of income. It's more accessible to people who can't spend time on their trading, right? But this ignores the fact that there is a very distinct hierarchy that would be emphasized by high frequency trading. Because the point at which is reliant upon having a more sophisticated algorithm or a better connection and being able to make these trades faster than other people because it's built on exploiting the poor decision making of other investors, right? Is a point at which inherently it is less accessible to people who don't have those things, because the watered down app version you have on your phone is going to be significantly less sophisticated than the versions used by people who do this professionally, right? Who can set up in offices. And so that's unlikely to maintain to be the case. And the extent to which it might be at the moment, that's because not all people have bought into these technologies yet. And so if you are using high frequency trading to your benefit, it's likely to have the expense of just like an old person who's trying to save for their retirement and is now making comparatively worse trades because of the technology that you're using, right? So the claim that like it therefore levels the playing field ignores all of these things. And it's important to recognize that to the extent to which we have to concede that there is still asymmetricality in how much people can benefit from the market based on like whether or not they can spend all day doing it. The point is that even if I'm like an all-day stock trader, it would be a monumental task for me to try squeeze other people out of the stock market. So the extent to which, like, sure, individual people just doing this as a pastime probably can't benefit as much as professionals under either side of the house. The problem is that under their side of the house, professionals who are like teaching computers to become the perfect trader can squeeze other people out of the stock market, and that on general, those people will be more harmed under their side of the house, right? So where we end up is that the only meaningful response to our material we get from the opposing team is the idea that like we somehow have a contradiction because he said that these people trade slower and then can't keep up. But these are the same thing, right? Because if you are trading, say, less frequently, you're checking it day to day, week to week, because you're just caring about your retirement and you like want to live your bloody life. At the point in which like your stock you've invested in now has a downturn and computers are going to sell quicker so that they aren't the victims of that downturn, you will now be like thousands, if not millions, of trades behind those computers, which means that the kinds of downturns you see will be more acute and you won't be able to keep up and you won't be able to maintain solvency of your stock portfolio, at which point you are more likely to be harmed. Okay, so what is important? Even if people have access to a watered down version of the technology, let's engage with what the most vulnerable trader typically looks like, right? They are just a person who's saying like, okay, I have a couple $1,000, maybe I want to get some return on it, maybe I want to save for my retirement. So I'm just going to put money in companies that are relatively familiar to me, that I shop at, that have a good reputation in my mind, right? That is not the super rational decision. Those people are therefore abused by the stock market and abused by high frequency trading and are harmed under the opposing team side of the house. The role of economic law is to protect vulnerable individuals and prevent these kinds of harms and scams. That's why we win this debate. Okay, on the second issue of economic harms. So again, the stuff about how it just like all these trades balances out is incongruent with reality, at which point high frequency trading would be of no profit if you're just selling the same stocks over and over again, back and forth between bots. Okay, so we told you that especially at Colby split, that it's important that the stock market is used as an indicator. So just dismiss this and say that, oh, it's only Trump, is to ignore the fact that the reason Trump's doing that is because it's generally accepted as an indicator. You see it every day on the news, right? And they also just like conceded this at the point they said that like a lot of the changes in the stock market are reflective of the policy decision making, in which case it would be a useful like metric of economic policy. So that makes it incredibly harmful at the point where people just don't know what the hell's going on, right? And they don't understand these unintelligible machine learning algorithms, because part of the technology is the fact that like you just don't know how the algorithm works. You just set it up and let it build itself, right? And so what happens on the opposing team in this house is that the social value of the stock market as an indicator of economic health and what should be done with economic policy is lost. And that's a unique harm that happens under the SI house. And we think is enough to win this debate, given how like economic policy should be built on protecting itself and like preventing recessions, the kind of things that the stock market could be used to predict. Okay, so they just said that like people are irrational actors. They're probably more likely to drop and like buy in more larger individual amounts. Okay, so firstly, it's not as if individuals can make these huge effects in and of themselves, day-to-day traders, or it's thrown like a couple of $1,000s, which is pennies on top of the total amounts we're talking about. Colby already said that. But also it's important to recognize that like individuals are more varied amongst their decision-making than computers are likely to be, particularly as the technology develops, like I've told you, with a lot of this machine learning material, which is like being developed down the line. Because at which point, like computers are all trying to make the same kinds of trades, to make the same kind of profit. They're likely to make the same kinds of decisions. And so to claim that just like, oh, the stock market has gotten better since the invention of this trading is to ignore the fact that like, that's just confounded by the fact that like there's been legislation and probably just more caution after things like the 2008 stock market crash. What actually happens is that all the trades, as these increasingly dominate the stock market environment, are now more likely to be similar, more likely to happen at the same time and be more acute, which increases the fluctuation of the stock market, which we think is harmful as an indicator. It's harmful to companies whose like value wildly changes, and it's harmful to people who just want to invest normally. Okay. At the point in which everyone's doing this, it becomes perfect, and the stock market is basically just ruined as the technology develops. Okay, why is this important? We can win on either side of this house. The fact is that high frequency trading, even with all of their material, brings little to no meaningful benefit to anyone. If we can prove to you that there are sufficient economic harms or individual harms to vulnerable individuals, we win this debate. Thank you very much.
Thank you, third affirmative. Next, I'd like to call upon the third negative. Here.
Hi, can everyone hear me?
Yes.
Okay, could you just give me a minute to set my timer?
Yeah, take your time.
Thank you. Okay. So I think what this debate essentially boils down to is the idea of accessibility and the idea of whether or not removing the human element of trading or allowing for a non-humanistic kind of metric when making decisions in terms of trading, allowing robots to take over that sex necessarily is a good thing for the economy and for the individual, right? So let's just talk about this in the first place. First, let's address this whole clash about whether or not, like this whole point that they brought up about whether or not the stock market should be a moral reflector of society in the first place, and whether or not allowing machines to allowing robots to actually trade in our place necessarily disincentivizes companies to innovate or be moral in their like workings, right? Now, first of all, let's contend with this idea that like high efficient not high efficiency trading, HFT necessarily like is a reflector of like investor confidence, right? So recognize that majority of companies, stocks and shares are not constantly being traded, right? The amount of the percentage of shares that are being traded in this HFT is a small percentage of the larger market, right? We have a lot of investors who are long-term investors who want to see the growth of these companies and want to hold on to their shares in order to reap the benefits of the business activities of these companies, right? And it's these investors that matter because these are investors who represent the interests of the company. Whereas traders who trade in HFT only hold on to those shares and stocks for like a few minutes or even a few seconds, right? And they don't necessarily reflect like investor confidence in the long term or necessarily reflect any sort of confidence in the way that the company is working or the ethics of the company, right? But more than that, even if that's true, right, we don't think that investors hold all the power in dictating how a company behaves, right? We think that investors provide capitals, but when it comes to bargaining, when it comes to pushing or lobbying for more moral ethics or better procedures from the company, right? Governments and consumers are the check and balance, right? So furthermore, if destabilizing the company is a pivotal way to lobby, which means that if pulling out your shares and whatnot is a pivotal way to lobby, and they think that bots can't do it, right? We think that in order for people to be for the stock market to actually be a moral reflector, the basis of this can only this can only happen at the point in which there's actually participation from all sects of society, right? Because we think that as status quo, the problem is that the only people able to interact with these companies, the only people able to influence like the stocks of these companies or even get enough money to have some sort of say in these kind of situations are rich people, right? And we think that like the middle income individual, lower middle income individual should be able to interact with this system as well and have a say in this if that's a premise of opposition's case, right? We think that the point in which individuals are going to be able to access these stock markets, this is when these individuals will be able to have some sort of bargaining power in terms of the way that these companies work, right? How does this, why is this true in our case, right? Now, this is left largely unengaged throughout the whole of this debate, even though it's brought to you in first speaker, right? What we told you is that you don't necessarily need to invest large sums in order to invest, unlike in like your typical hedge funds, unlike your typical trading that doesn't involve HFT, right? Because you don't have to necessarily have $20,000, $30,000 in order to invest, right? What this means is that you give a small amount of money, maybe a couple of thousand, into a pool of money, which is then traded for you. And even though even though your profits are marginal, right? We think that the risk is very much diluted, which means that poor people can afford to make this loss if there is a loss in the first place, even though largely it's quite safe because these machines actually depend on objective metrics and factors in order to make the decision of what would be most profitable, right? More than that, we think that what we already addressed from the start, which wasn't contended along the way and provided and opposition provided no other solution for this, right, was the fact that median wages are not necessarily increasing, right? We think that a lot of people are being disenfranchised. A lot of people are losing their ability to survive in societies where the rising cost of living are increasing, even though their wages are not, right? And they need some sort of secondary source of income. And a lot of rich people are being able to exploit the stock market to garner a lot of income, actually increase the gap between the rich and the poor, right? We think that the only way to kind of bridge this kind of gap is to allow individuals to trade in the stock market and have some sort of access to that, right? We've already proven to you that this is not as inaccessible as they make it seem, right? We've proven to you that we have developed apps like even on your phone where you can basically trade, but you don't have to have a large sum of money and you don't have to have prerequisite knowledge in order to engage, right? In their world, like we've already proven to you that only people who are either very, very rich and can afford like a lot of stockbrokers or to actually invest large sums of money at one go are going to be able to engage the stock market, or people who are financially literate in terms of investing in stocks, right? These are the only two types of people who will be able to trade in your world, right? Now, let's actually break the debate down into what will happen in government's world and what will happen in our world in three sections, right? The first thing about market volatility. So what are the causes of market volatility, right? We think that in government's world, the causes of market volatility are misinformation and emotion, right? Because recognize that investors don't always act rationally, right? Sometimes they depend on their emotions or their prejudices and biases when they make decisions of whether to pull out or whether to stay or to invest in a certain company. More than that, we think that there's a lot of misinformation, which means that sometimes investors place more importance on things that are on factors that are not as objective, on factors that are not as important to the business's workings. And we think that sometimes investors can also misinterpret into information that's provided to them, right? Now, the problem with this is that the scale of the impact, the scale of the impact of these investors pulling out is a lot larger, because in your world, investments can only come from people who are relatively richer, who are willing to take bigger risks and therefore tend to buy a lot of stock at one go and therefore sell a lot of stock at the same time, which is the cause of market volatility, right? Whereas in our world, the instability that supposedly happens is caused by the speed of the transaction, which we've already proven to you actually kind of averages out the volatility of the market, right? Because it happens on very, very small scales, and it happens so instantaneously that it doesn't look like the machine buys like 1,000 stocks and then sells it in that 1 second, right? They buy small amounts and then trade really quickly, right? Which means that there's no very big impact on the company, and markets don't necessarily crash as a result of that, right? So we think that on our world, why it's even better is because the metrics the criteria for trading that the machines depend on are things like data, right? Or things like the profits of the business, or the kind of patterns of individuals buying stock, or predicted like prices of stocks and whatnot, right? As opposed to on your world, where people just depend on their emotions, and a lot of people may not be educated, which means that they either shut out of the whole stock market, or they enter the stock market feeling unsure and having a lot of people with more information than them, right? Whereas like machines can actually make more objective decisions that will lead to better outcomes, which in our world. So in that case, we take the debate. But more than that, right, in terms of accessibility, which has been a huge contention. So let's look at it on their world, right? On their world, individuals do not have access to the stock market unless they have enough to meet the principal amount needed, because like there's no incentive for stockbrokers to necessarily do very, very small investments anyways. And secondly, individuals who are educated enough to actually do it on their own, right, even though they're going to incur a large amount of risk, which cannot be afforded for people who are not as rich, right? But more than that, right, let's look at our world, right? In our world, the worst case scenario is that the quality of in our world, the worst case scenario is that richer people may be able to afford better computers or whatnot. But we think that even if that occurs, right, we think that at least they'll be able to get some sort of marginal profit from trading in it, and they'll be able to get some sort of basic secondary income, which will address the initial problem of them not being able to survive on their median wages without having to take large risks, right? Because recognize when these people trade, they're not trying to out-trade very rich people, right? What they're trying to do is just get some sort of secondary income in order for themselves to survive. So we think that even if in our world, richer people will be able to accrue more money, we think that it doesn't really matter insofar as these people are going to be able to at least get some sort of secondary income, and insofar as the metrics for investment by the machines are not necessarily subjective, which minimizes the risk. Lastly, we talk about unstable markets. So the reason why like the stability of markets are important is because stable companies lead to more job creation at higher wages, right? We think that on our side, we've already proven to you that removing the human aspect of trading necessarily means a more optimization of the market, and we think that for all those reasons, we took the debate.
Thank you, third negative. Next, I'd like to invite the negative reply. Here.
Hi, can I be heard?
Yes.
All right. I'm going to first clarify the nuance that side Affirmative never responded to, which is that the way stocks work is that there is a buy order and a sell order. So on both ends of the transactions, there are bots that are firstly dictating how much money they're willing to buy a stock for, and secondly, dictating how much money they're willing to sell a stock for. I think this was a key piece of characterization that I presented in my first speaker speech, because it deals with the idea that side Affirmative wants to deal with, right? Because side Affirmative, what they want to do is they want to level the playing field. They want to essentially make it so that a small stock investor is able to compete with large companies making use of high frequency technology. What Zing and I both then told you is this idea that, like, look, is a human trader, if you're trying to outcompete another human trader in a large stock firm, the chances are very minuscule that you'll be able to do that. We think that exploitation is a non-mutually exclusive problem that happens on both sides. Because on both sides, someone who makes a bad decision is going to get exploited by the stock market. What we told you then is the idea of leveling the playing field is to introduce AI tools which allow you to not have to put in your own stupid emotions and your own stupid rationality into trading stocks, and therefore you can benefit from those things, right? And that was our very clear stance. We never heard any engagement in terms of other than fear-mongering about how robots are all going to be the same, despite the fact that that's not how machine learning works, and they never explained to us why that must necessarily be the case. Next, They wanted to talk to us about volatility. And here's the problem, right? The problem is that both, I realized at the end that both teams are debating on very different definitions of volatility. So what's the affirmative definition of volatility? The affirmative definition of volatility is you can't predict how many times a stock is going to go up and down and up and down. The reason for this is because a bot is going to buy a share at 20 cents, and then like he may or may not buy the next share. But then another bot at a fraction of a second may decide to sell that share for 20 cents, and then that bot is going to buy that. So you can't predict the up and down, up and down. But what this results in is actually numerous high frequency small trades. Because when a bot wants to buy something, another bot that can react as fast as that is going to react to the price that they're going to buy it for. We think, as we told you from first to third, what happens then is that yes, you may get many small incremental differences in terms of several cents, but what's going to happen is that you're generally going to see a stable trend line that is only largely going to react to things like financial crises, big company scandals, companies going bankrupt, right? We think that these are going to affect the major trend lines, but the minor trend lines are going to be relatively consistent. Then what was their accusation about how? So what was then our accusation about how they're actually volatile? I want to tell you a story, which is to say, what happens when you're a day trader? Let's say that you walk into your Wall Street office at 8 a.m. and you clock in for work. What happens then? You see that there's a stock that is surprisingly being undervalued in the market. And what do? Because you realize that stock is at a low price, you buy up as much of that stock as possible. Because there are no high frequency bots on the other side, and you don't have high frequency bots yourself, you're able to buy all of that undervalued stock at once, rapidly shooting up the price of that stock. We think that causes things like market crashes and market rises rapidly. That's what volatility actually is. And we told you why that's particularly harmful, because it results in inconsistent results for companies. They actually don't feel like they need or are incentivized to do things when they see huge windfalls like this. So moving on, 2 metrics. Firstly, who is harmed most in this case? We need to recognize that on the metric of accessibility, I think we benefit more, because the reason why this high frequency technology is particularly beneficial is precisely because it hasn't been banned, it's been able to be accessible and usable by the commercial market, which means as many individuals can use these things as possible, compared to stockbrokers who need to study for like years on end the stock market, and even then they may not succeed, and your mom and pops who want to do it for fun and only invest in well-known companies, right? We think that by introducing this technology, it levels out. And secondly, in terms of the kinds of mechanisms on both sides, we just proved to you why high frequency creates a more stable area, and this technology in particular benefits more people. For those reasons, go with side negative.
Here. Thank you, negative reply. The last speech of the debate, affirmative reply. Here.
According to side negative, what the stock market looks like and what high frequency trading looks like is bots selling individual shares for minuscule prices so nothing changes. Well, we've told you all down the line that this simply isn't true, because at the point you can sell like shares so quickly, your risk is very, very minimal, because as soon as you see a slight like decrease, you sell them, and like that's how you minimize your risk. So that means that all their mechanisms about like the stock market being more stable just simply aren't correct. But more importantly, let's talk about how we win this debate today. Both teams can agree that accessibility is like one of the key things we want to protect. We want to stand for financial institutions making the world a better place. This means I've got 3 questions about this debate. Firstly, what makes a good high-frequency trading system, and why does this shut individuals out? A good high-frequency trading system relies on having the best AI technology. It relies on having the best algorithms. It relies on having like the best Wi-Fi and the most up-to-date supercomputer, right? What does this mean? It means that even if you have access to Neg's best case scenario, which is like an app on your phone, that is still going to be slower than whatever is sitting on Wall Street. That means you're never going to be able to sell things at the same speed as what is happening on Wall Street. That means as soon as stocks start going down, all the like supercomputers and like super algorithms are already going to have offloaded and you are going to lose out. Like none of their material about open access technology stands. But more importantly, we've showed you that a lot of people can't even like buy into this technology in the first place, and they're doing it themselves. And so let's talk about like the mom and pop trader who like invests, right? Well, under their side of the house, these people now have no option but to compete with these supercomputers because this technology is so efficient, it pushes everyone out. This means that these people, even if we take Neg at the best and say they're like trading typically stable long-term investment stocks, although they never told us what these look like, on their side of the house, these things are just going to start to like rise and fall as rapidly because computers panic when they see things starting to fall and like quickly sell them. The people on their phones who only check this like once a day can never keep up. This means these individuals get hurt. It means they lose their retirement savings. And they're never going to be able to invest on the same scale of technology. Now let's talk about economic harm. So what Aff wanted to tell us was that bots are predictable and make good decisions. Well, we firstly like completely disagree on this. Why? Because we think what the bots are likely to be making massive like trades, as I explained to you, in my introduction, because the risk seems low. But we also think the stock market is hurt when lots of people trade in the same way, and that is exactly what happens when we have high frequency trading, because all the algorithms like self-learn and become the same. So we get massive trading, and that means we get massive dips and falls. We also like get worse harms that no one has any idea what's going on because no one can keep up with the pace at which these technologies are teaching themselves. So we think when we ban high frequency trading, we make the world less likely to have like whatever like weird stock market crash happens. But even if we accept that they are not volatile, if we take them at their absolute best, we have had no response to our material on how currently companies have like good incentives to attract investors, how companies are currently like sustainable and ethical to attract investors. And we heard like a very marginal response to this at Third Neg that doesn't respond to our mechanisms about how people just like investing in good companies. We think this is really important because financial institutions want to make the world a better place. Both teams agreed on that, and we get that when we have responsible companies. So we think we can also win on that point alone. Proud to affirm.
Right, thank you everyone for the debate. I think the outcome is going to